Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden in plain sight within corporate filings. And today we're looking at Applied Industrial Technologies, Inc., and a report that smells like a fresh loan. Stick around if you love getting straight answers from the confusing world of corporate finance. Make sure you are subscribed and join our growing community on Discord, all linked in the description below. So Applied Industrial Technologies, or as well call them 8, has just signed a pretty big deal. They've secured a massive $900 million credit facility. That's a lot of money, and it's called a revolving credit facility, which is like a giant line of credit that they can borrow from and pay back as needed. Think of it like a supersized credit card for a business. This new credit line is set to mature in October of 2030. That gives them a nice long runway to use these funds and figure out their financial strategy. Plus, they have the option to increase this even further by another $800 million. That is a potential total of $1.7 billion in borrowing power. Wow. Now, why do they need this much money? Well, a big part of it is to pay off their old credit agreement, which is smart. They're essentially rolling over their debt into a new, presumably better deal. And the rest that's for their everyday business operations, what they call working capital, and also to fund any potential acquisitions they might have in the pipeline. Sounds like 8 is planning to grow. Let's talk about the cost of this money. They have a couple of options for how they'll pay interest. One is based on something called the base rate plus a small extra percentage or margin, which can be as low as 0% up to 0.35%. That's a really low cost on the base rate. The other option is pegged to something called the adjusted term SOFR rate, plus a margin that's a bit higher, ranging from 0.80% to 1.35%. The specific rate they pay will depend on their net leverage ratio, which is basically how much debt they have compared to their earnings. This is pretty standard for large corporate loans. It means they get a better interest rate if they keep their debt under control. Now, with all this borrowing power comes rules called covenants. These are basically promises they've made to the banks. They can't just go out and borrow unlimited amounts of money or sell off all their assets without talking to the lenders first. They also have to keep their interest coverage ratio above a certain level, meaning they need to be earning enough to comfortably pay their interest payments. Here is a really interesting part. While to raise a limit on how much debt they can have relative to their earnings, if they make a big acquisition, they can ask permission to temporarily increase that debt limit. This is a clear sign that they are serious about expanding through buying other companies. It signals a growth-oriented strategy. This new agreement effectively replaces an older credit agreement from December 2021. It's common for companies to update their credit lines as their business needs change or as they can secure better terms. This move suggests they're either outgrowing their old agreement or have found a more favorable arrangement. And here is the actual credit agreement itself filed as an exhibit. It's a thick document, but the key takeaway is the $900 million facility. The asterisks and notes indicate that some parts of the agreement have been kept private, which is pretty normal. They've agreed to share those private sections with the CC if they're asked. So, what does this all mean for Applied Industrial Technologies? On the surface, this is a very positive development. They've secured significant funding that will allow them to manage their existing debt, fuel their operations, and potentially acquire new businesses. This indicates a company that is confident in its future and is looking to expand its reach and capabilities. The interest rates are also quite favorable, especially if they maintain good financial discipline. However, we need to remember that this is a loan, and it comes with obligations. The covenants they've agreed to will restrict some of their financial flexibility, and they will need to diligently manage their debt levels to avoid breaching any agreements. The fact that they can increase their leverage for acquisitions is a double-edged sword. It allows for aggressive growth, but also increases the risk if those acquisitions don't pan out as expected. Looking ahead, 8 seems to be in a strong position for growth, driven by both internal operations and potential external expansion. The key will be how effectively they manage this new debt and how wisely they deploy the funds, especially if they go the acquisition route. It's a bold move, and we'll be watching to see if it pays off for them. Alright, that's our breakdown of Applied Industrial Technologies' latest financing report. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.